Welcome back to the MonsterInvest channel. I'm your host, Daniel. I want you to take a moment and close your eyes. Picture yourself as an architect. You have been hired to build a house, but this isn't just any house. This house needs to stand for 100 years. It needs to survive hurricanes, earthquakes, blistering heat waves, and freezing winters. Now consider two different builders approaching this project. The first builder, let's call him Tom, is obsessed with speed. He wants the house to look impressive today. He spends all his budget on gold-plated faucets, massive glass windows, and a flashy marble driveway. But because he spent all the money on the surface, he skimped on the foundation. He used cheap concrete. He didn't bother with steel reinforcements. When the house is finished, it looks magnificent. It shines in the sun. Tom is celebrated as a genius. Then there's the second builder, Sarah. Sarah is boring. For the first 6 months, you don't even see a house. You just see a hole in the ground. She is pouring tons of reinforced concrete into the earth. She is testing the soil stability. She is installing drainage systems. When she finally builds the walls, they aren't made of glass. They are made of reinforced brick. The house doesn't look flashy. It looks sturdy. 10 years go by. The weather is nice. Tom's house is the talk of the town. Sarah's house is ignored. But then the storm of the century hits. The wind howls at 100 miles per hour. The ground shakes. In the morning, the sun rises over the aftermath. Tom's house, the glass is shattered. The foundation has cracked. The roof is gone. It is a ruin. And Sarah's house, it's still there. A few roof tiles are missing, maybe a window is scratched, but the structure is solid. The family inside is safe. In the world of investing, 90% of people are Tom. They are obsessed with the now. They want the returns that look good on Instagram. They want the crypto coin that moons overnight. They want the tech stock that doubles in a week. They are building glass houses on sand. But today, we are going to learn how to be Sarah. We are going to learn how to build a sustainable investment portfolio. A portfolio that is designed not just to make you rich, but to keep you rich. A portfolio that survives the economic storms that are guaranteed to come. So settle in. This is going to be a deep dive. We are going to deconstruct the engineering of wealth. Let's start by defining our terms. What does sustainable actually mean in finance? It doesn't just mean green or eco-friendly, although that can be a part of it. In this context, sustainable means durable. It means a portfolio that can sustain your lifestyle and your peace of mind indefinitely. To build this, we have to identify the 3 predators that are hunting your wealth every single day. Predator number 1 is inflation. This is the silent killer. It is the termite in the walls. If you bury your money in the backyard or leave it in a checking account, you are losing. Inflation eats away your purchasing power by 2 to 5% every year. To be sustainable, your portfolio must grow faster than inflation. Predator number 2 is volatility. This is the storm. The market crashes of 2000, 2008, and 2020. Volatility is the price you pay for growth. If you cannot handle the swings, you will panic, and panic is the death of wealth. Predator number 3 is you. Yes, you. Human psychology is the biggest threat to a portfolio. We are wired to run from danger and chase pleasure. In investing, this means we naturally want to sell when the market crashes, which is running from pain, and buy when the market is booming, which is chasing pleasure. This is the exact opposite of buy low, sell high. A sustainable portfolio is a system designed to protect you from yourself. So how do we build Sarah's house? We use 4 primary building blocks. These are your asset classes. First, we have equities or stocks. These are the engine. Stocks are ownership in real businesses. Over the last century, despite wars, pandemics, and depressions, the stock market has been the greatest wealth-generating machine in history. You need stocks to beat inflation. They are the engine of your car. But remember, a car with a massive engine and no brakes is dangerous. This brings us to the second block, fixed income or bonds. These are the brakes and shock absorbers. Bonds are loans. You lend money to the government or a company, and they pay you interest. Bonds are generally boring. They don't double in value overnight, but here is the magic. They often move in the opposite direction of stocks. When the world is ending and stocks are crashing, investors run to safety. They buy government bonds. This drives bond prices up. So when your stocks are bleeding, your bonds are healing the wound. They stabilize the ride. Third, we have real assets like gold, real estate, and commodities. These are your insurance. Paper money can be printed endlessly. Real estate cannot. Gold cannot. In times of hyperinflation or extreme fear, these assets often hold their value better than paper assets. They are the fire insurance on your house. You hope you never need it, but you are glad you have it. And fourth, we have cash. This is the oxygen. Many investors hate cash. They say cash is trash because of inflation, but I say cash is oxygen. When the market crashes 50%, the person with no cash panics. They might have to sell their stocks at the bottom just to buy food or pay the mortgage. The person with cash, they breathe easy. They sleep well, and more importantly, they have the ammunition to buy up cheap assets while everyone else is selling. Now let's put these materials together into a blueprint. This is called asset allocation. And to explain this best, I want to tell you a story of two investors. Let's call them Marcus and Sophia. This is a case study that happens in real life every single cycle. Let's go back to the year 2020. The pandemic has hit, money is being printed, and the markets are going wild. Meet Marcus. Marcus is 30 years old. He works in marketing. He is smart, ambitious, and he wants to retire by 40. Marcus looks at the stock market and sees that tech stocks and cryptocurrencies are skyrocketing. He thinks, why would I buy bonds that pay 2%? That's for old people. I want growth. So Marcus builds his portfolio. He puts 70% in high-flying technology stocks, companies that make no profit but have great stories. He puts 30% in speculative cryptocurrencies. He puts 0% in bonds and 0% in cash because he invests every penny. For 18 months, Marcus looks like a god. His portfolio is up 150%. He is making money faster than he can spend it. He mocks Sophia for being too conservative. He is the builder Tom, building the glass house. Now meet Sophia. Sophia is also 30. She works as an engineer. She understands systems. She knows that what goes up must come down. She wants wealth, but she wants to sleep at night. Sophia builds a sustainable portfolio. She puts 50% in a global stock index fund, owning 5,000 companies, not just tech. She puts 30% in bonds, focusing on government and high-quality corporate debt. She puts 10% in gold and real estate investment trusts, and she keeps 10% in cash held in a high-yield savings account. During the boom, Sophia makes 12%. Marcus makes 150%. Sophia feels a little FOMO. She wonders if she is doing it wrong, but she sticks to the plan. She is the builder Sarah, pouring the concrete foundation. Then comes the turning point in 2022. The weather changes, inflation spikes, the Federal Reserve raises interest rates, the era of free money ends. The speculative tech stocks that Marcus owns, they rely on cheap debt. When rates rise, they crash. They drop 50%, then 70%. Crypto enters a brutal winter. Marcus's coins drop 80%. Marcus's portfolio, which was worth $200,000 at the peak, is now worth $50,000. But here is the real tragedy. Marcus is stressed. He sees his life savings evaporating. He panics. The psychological pain is too much. At the very bottom of the market, Marcus presses the sell button. He goes to cash to stop the bleeding. He cements his losses. He is out of the game. Now look at Sophia. When the crash hits, her stocks drop 20%. That hurts, but her bonds holding steady, they mitigate the drop. Her gold, it actually goes up slightly as fear enters the market. Her cash, it's still there. Sophia's total portfolio is down maybe 12%. It's annoying, but it's not a disaster. She is not panicking. She's sleeping 8 hours a night. And because she has that 10% cash, she does something brilliant. She takes that cash and she buys the stocks that Marcus is selling. She buys high-quality companies at a discount. Fast forward to 2025. The markets have recovered. Marcus is still sitting in cash, too afraid to enter the market again. Sophia's portfolio has fully recovered and is now hitting new all-time highs. Her compounding has continued uninterrupted. This is the power of sustainability. It's not about having the highest peak, it's about avoiding the deepest valley. But building the portfolio is just step one. Maintaining it is step two. This is where the magic of rebalancing comes in. Think of your portfolio as a garden. You plant roses, which are your stocks, and hedges, which are your bonds. After a year of good sun, the roses grow huge. They are taking over the garden. They now make up 80% of your garden, instead of the 50% you planned. This looks good, but it's dangerous. If a blight comes for the roses, you lose everything. Rebalancing is the act of trimming the roses and watering the hedges. Mathematically, it looks like this. If your stocks go up and now represent 70% of your portfolio instead of 60, you sell the extra 10%. You take that profit and you buy more bonds, which are currently cheap because they haven't grown as much. Reflect on what this forces you to do. It forces you to sell high, selling the stocks that went up, and buy low, buying the bonds that lagged behind. You don't need to predict the market. You just need to tend your garden. You do this once a year, or maybe twice. It removes emotion from the equation. I also want to touch on something that most financial advisors ignore, which is your sleep number. A sustainable portfolio is personal. The math says you should be 100% in stocks if you are young, but if a 30% drop in the market makes you physically ill, then the math is wrong for you. If you panic and sell, your return is zero. It is better to have a suboptimal portfolio that you can stick with for 30 years than a mathematically perfect portfolio that you abandon after 3 years. You need to ask yourself honest questions. 1. If my portfolio dropped 40% tomorrow, would I buy more, do nothing, or sell? 2. Do I need this money in the next 5 years? If the answer is yes, it shouldn't be in the stock market. And 3. Am I investing for a legacy or for a Lamborghini? Finally, let's look inside the engine. What kind of companies make up a sustainable portfolio? This brings us to the concept of quality. A sustainable investor doesn't just buy a ticker symbol, they buy a business. You want companies with moats. A moat is a competitive advantage that protects a business from attack. This could be a brand moat like Coca-Cola or Apple. People pay more just for the name. It could be a switching cost moat like Microsoft. It's too hard for businesses to switch away from Excel, so they stay forever. Or it could be a network effect moat like Visa or MasterCard. The more people use it, the more valuable it gets. You also want to look at the financial sustainability of the company. Do they have too much debt? Are they burning cash? And yes, look at their environmental and social impact, not just for moral reasons, but for risk reasons. A company that pollutes a river is a company that is one lawsuit away from bankruptcy. A company that treats workers poorly is a company that will face strikes and turnover. Sustainable investing means buying companies that will still be here and still be profitable in 20 years. So how do you start? How do you build your fortress? First, assess your foundation. Build an emergency fund of 6 months of expenses in cash. This is your shield. Second, choose your allocation. Are you aggressive, moderate, or conservative? Be honest about your risk tolerance. Third, keep it simple. You don't need to pick 50 individual stocks. Buy broad market index funds or ETFs. Buy the haystack, don't look for the needle. Fourth, automate it. Set up a monthly transfer. Treat it like a bill. You are paying your future self. And fifth, tune out the noise. Stop watching the daily news. Stop listening to the guy at the bar who made 500% on a penny stock. He won't tell you when he loses it all next month. Before we end this episode, let's recap the key lessons for those listening. Number 1, sustainability beats speed. The goal is to survive long enough for compounding to work. Be the oak tree, not the poplar. Number 2, diversification is survival. Stocks give you growth, bonds give you stability, cash gives you options. You need all of them to weather the changing seasons. Number 3, manage your emotions. The market is a mechanism for transferring wealth from the impatient to the patient. Be the patient one. Number 4, rebalance. Regularly trim your winners to buy the underdogs. This automates the practice of buying low and selling high. And number 5, focus on quality. Invest in things that have real value, real cash flow, and real staying power. Building a sustainable portfolio is not the most exciting thing you will do. It won't give you an adrenaline rush, but it will give you something much more valuable. Freedom. Freedom from worry. Freedom from the rat race. And the freedom to live your life knowing that your financial foundation is built on rock, not sand. Thank you so much for listening to Monster Invest. If you found value in this deep dive, please do me a huge favor. Hit that like button. It really helps the algorithm show this to more people who need to hear it. Share this episode with a friend who might be taking too much risk or someone who is just starting their journey. And if you haven't already, make sure to subscribe and hit the notification bell so you don't miss our next strategy session. I'm Daniel. Go out there, build your fortress, invest wisely, and I'll see you in the next episode.